Does pulling your credit affect your score? Let's find out. Okay, Shane, so I had a client that was wondering how much does pulling your credit affect your credit score?
Not nearly as much as it used to.
Okay.
It really depends on what all is on the credit report, but you can usually see a couple of points. They changed all the laws back in 2010 whenever they passed Dodd-Frank, and that's actually one of the good things that they did was they want more transparency and they encourage people to shop around for different lenders. So the scoring model of how much it affects your score is minimal at best. It was a
Okay.
lot more prior to that.
So you mentioned they want you to shop around.
Mm-hmm.
So is there a set number of days or that window that they can do
It's
that?
not necessarily defined, but the rule of thumb is 2 weeks. You can have your credit pulled as many times as you want within a 2-week period by mortgage companies, and it only counts as one pull. So
Okay.
that's one of the reasons why it only affects your credit score just a little bit.
Gotcha. That's really good. So another question that I've gotten a lot is what is the difference between a soft credit pull and a hard credit pull?
So we've been getting that a lot lately. There
Okay.
are companies out there that are offering soft credit pulls, but the thing is with the soft credit pull is you don't have all the information. So it's technically, if somebody's pre-approving you, they're not really pre-approving you. They're pre-qualifying you. And we have already starting to see results where somebody gets under contract with a house, they get a soft credit pull, and then they start doing all the actual real work, and now they're denied because they
Right.
didn't get the full story ahead of time.
Right. So how can you, I guess, educate someone on the difference in like if they know going into the application if they're going to be getting a soft or a hard credit
I
pull?
explain it all to them up
Okay.
front and let them know kind of what we're doing and how it all works. And the first question they always ask is, will it affect my score, et cetera, et cetera. So I lead them down the path of the differences and the pros and the cons.
Okay. So before they submit an application, just give you a call and you'll be able to explain the
Correct.
difference. Okay. Great. So a lot of people are talking about buying down rates and what that is. So let's talk about that and kind of educate people on the process and what that looks like.
Yeah, it's a big topic right now because there are different types of buy downs, right? There's temporary buy downs, there's permanent buy downs. And so you really have to look at what your goals are for the house that you're purchasing and how your contract is structured. Because sometimes the seller can pay for the buy down, and that's a good thing. But in the current market that we're in right now, actual borrower buying their rate down or buying points down, you really have to turn around and look at the return on the investment and what the goals are of the current house and use the data to make your decision on that.
That's great information. So why do people think that they need to put 20% down?
Probably because of their parents told them that, honestly. When you actually look at, when people are actually shopping for mortgage and they have this mentality, usually from guidance from their parents or their family members because those programs didn't exist back then
Right.
when their parents bought their first house. And that really leads into having to pay mortgage insurance or not. If you put 20% down on a conventional loan, you don't have to pay mortgage insurance. Sometimes, a lot of times actually, it's actually smarter to pay the mortgage insurance and not put that huge chunk of money.
Okay, so you just mentioned PMI, right? So let's break that down and explain that to someone who may not know.
Sure. Private mortgage insurance is kind of like the double-edged sword in the mortgage industry. It's what allows people to buy a home without putting 20% down, but then you have to pay for that insurance policy. How you get rid of it on a conventional loan is once you hit the 78 loan to value percent, it usually typically falls off. Sometimes you have to call your servicer, who you make your checks out to, and get them to actually do it. Sometimes they charge a little fee, $100 or something like that. Or you put 20% down whenever you purchase the home.
Okay. So you mentioned at 78%, then that private mortgage insurance can drop off, right? So how does someone know when they've arrived at that 78%?
Well, there's two ways to do it. Most servicers, they'll use like an automated value. They won't actually typically send an appraiser out, but they'll usually charge like $100 or something that you can pay to get it to fall off. And what we do for a lot of clients is we do a recast. So say somebody wants to say, hey, I got my annual bonus and it's whatever, $40,000. And then say, I want to apply that to my principal balance because I want to get rid of the mortgage insurance. Well, we'll do that. They can wire us the money. We charge a one-time $350 fee and that lowers their loan balance and readjusts their payment based on that new loan balance, and it gets rid of the mortgage insurance.
Okay, that's great. So another question that I get kind of often is what's the difference between the closing costs and the down payment?
Yeah, that's a great question. That's a question that comes up a lot, especially with first-time home buyers. They're kind of going into it like with a little bit of like deer in headlights.
Right.
So what always do is I make sure they have a clear understanding of what's what. So you obviously have your down payment portion of it, and then you have your closing cost portion of it. And the closing costs are typically broken down into two sections. There's your actual costs, and then you have your prepaids. And your prepaids are like your insurance and your taxes and your escrow account.
Right. Okay, so talking about down payments, another question that kind of ties into that is, do you have to put 20% down? Because I think so many people really think that they have to put 20% down and they don't even look at actually trying to apply for a mortgage because they don't have that money sitting there.
Right, that's a very common misconception.
Right.
There's so many ways to structure a mortgage, and how you structure a mortgage really depends on the goals of the client, and as well as down payment assistance programs. So you have to look at the whole spectrum of what's out there in order to actually have a proper mortgage strategy. And 20% down is definitely not something that you have
So
to.
if someone's looking to make a move, do they need to sell their current home before purchasing the new home?
Not always. If they qualify for both of the loans, then together, then they don't technically have to sell. What most people want to do is they want to sell so they can take all the equity and dump it into the new property and have a lower loan amount. So what we do in those instances for people that qualify to do that is we will recast the loan after. So case in point, I have one closing in 2 weeks. He has all of his equity tied up in his loan or his current mortgage, and he's buying a new one. So we're putting him in with the minimum down, 5% down, so that they can easily move out, move in. He's going to sell the house. He's going to probably do a little bit of fix up. Once he sells the house, he's going to take that lump sum. He's going to wire it to us as the bank, and we will recast his mortgage on that new loan amount and lower his payment. So it accomplishes both the task, but it's a whole lot less stress for them.
All right, so kind of a hot topic right now is, interest rates. And I think people are a little hesitant to purchase because they're looking at the rates and what they were over the last couple years in comparison to today. And they might be, sitting on the fence just if I personally have had a lot of clients that have been like, I love this house and I don't want to rent anymore, but oh gosh, the rates. So like, what are you telling people in that instance?
Yeah, and most of the people that are hesitant and fearful are first-time home buyers, or maybe they've only owned one home before
Right.
in the last 2 years or something. And so they are really only looking at a short-term period of time, what rates used to be just 2 years ago
Right.
versus what they have been historically. We're in a normal environment. Rates at 6% is a normal interest rate.
Yeah.
If you can get an interest rate between 4.5 and 6, you're fine. But most people don't understand that. And so when I have a consultation with a client, be it 30 minutes, 45, an hour, however long it takes, I show them, I map it all out for them, what it's going to look like now. And a lot of times they're only looking at the payment. They're not looking at the other positive factors of purchasing a home. They're
Right.
not looking at the tax benefits. They're not looking at the appreciation amount. They're just so focused on that payment. And if we can get them off of looking at the payment and looking at the big picture,
Right.
it becomes a lot easier and they get off the fence and they become more relaxed in the process. If you can map it out for them to show them, okay, yeah, your payments, it may not be great for the next year, but you can always refinance when rates drop.
Yeah, of course.
Whenever that makes sense, whenever the timing of the market is, time it as best you can. That's part of what I do is I monitor the market, I study it, I learn from it. We'll pull the trigger on a refinance and get you into the payment that's more acceptable. So I show them what your payment's going to look like now. Here's what your payment's probably going to look like in a year, year and a half.
So you mentioned refinancing, right? And that could be really great for the person that is a little hesitant right now to purchase. But, a lot of people have been sitting in a property for a few years and there's different scenarios. They may be thinking, is it time for me to refinance? So kind of talk through some of the reasons why people
Sure.
want to refinance.
Yeah. I mean, everybody refinances for a different reason. The three main topics or three main reasons why they refinance is to get a lower rate in a payment, to cash out, pull some equity out, or they're getting a divorce. Okay, divorce is always the most tricky one, right? It's emotional. It's an
Right.
emotional transaction.
Yeah.
But we got to get to the bottom of why they want to refinance, and once we figure out why, then we can, map out a plan for them. Most people, the vast majority of people right now who are refinancing, are pulling cash out. Some of them are refinancing out of an ARM, adjustable rate mortgage, that they've been in for a couple of years,
Right.
just to get it locked in because there are adjustment periods coming up. But most people are cashing out. I mean, I have a doctor client of mine. He's in his 30s, just drowning in student loan debt. And he just needs to get rid of the student loan debt because it's preventing him from making more
Right.
real estate moves. He wants to buy more homes, but he's capped. I put a plan together for him yesterday. He's going to pull $200,000 out. He's going to pay half of his student loans. Half.
Wow.
So, but it will allow him, when we do that, it will allow him to be able to buy 3 or 4 more
Right.
investment properties. And so I had to map that out for him, and
It makes
he sees
sense.
the benefit, and
Yeah.
it makes sense.
Right.
You refinance when it makes sense to refinance.
Yeah.